Señoras y señores, muy buenos días. Lamento que mi español no es suficientemente bueno para hacer este discurso en su idioma hermosa. Tendré que estudiar más. Perdóname si cambia en inglés ahora. So, we now live in times of extraordinary change. And I'm not talking about the last 3 or 4 weeks of market turmoil and virus. I'm talking about the last generation of dramatic transformation of the world in which we live. Just to illustrate that, who recognizes the place on the slide here? Anyone recognize this city? Anyone? Call it out. I said Singapore, Shanghai. Correct, gentleman there, Shanghai. This is Shanghai about 30 years ago. This is that same view today. See that again. See the green pyramid there on the left? That's about the only thing that stayed the same in one generation. And we've seen that level of transformation throughout our entire lives. And all of that transformation is built upon a number of technology platforms that follow this familiar shape that have been transforming our lives over the last century or so. Each of these platforms follows an S-curve. Early on, the early adopters, the innovators, they'll pick up something new. And then either it'll fizzle out and follow the blue line, or it'll cross the chasm and start to be adopted by the majority and start accelerating, following this familiar shape. Early on, it's only the crazy people who pick things up, or at least people perceive this new idea to be something crazy. But then when it goes beyond the early adopters and starts being used by the majority, it starts to be an exciting new thing to adopt. And eventually everybody's using it, and it starts to be normal. If we think about the automobile, perhaps one of the fundamental platforms that has driven change over the last century, when the first automobiles came out, they were noisy and expensive and dangerous, and the legislation said that you could only drive one if there was a person walking in front of you waving a red flag or holding a torch. So using one of these things was crazy, right? But soon they got better. Henry Ford developed a cheaper, safer alternative. It became something that was used by the masses and became an exciting thing to aspire to. And as we know today, having an automobile is just normal. But the transformation that this drove wasn't just changes in the way we get around. There was the early stage transformation where blacksmiths' shops and stables were made redundant and irrelevant and replaced by car repair shops and petrol stations. But it's actually the change on top of that which is more fundamental. The automobile has allowed things like commuter cities and working a long way away from where you live, and out-of-town shopping, and so on. It's allowed those kind of things to happen in a way that wouldn't have been possible in the era of the horse and cart. And in fact, an author, Carl Sagan, said, with the introduction of the Model T Ford, it was easy to predict mass car ownership, but much harder to predict Walmart. So when we think about these technology platforms, it's important to think about what is built on top of them and how that changes our world. Now, if we look at the right-hand side of my first chart, here you can see the last generation of technology platforms. The platforms of computer, the internet, the mobile, and the smartphone, which are essentially the foundation for the dramatic change that's made the last generation, the generation of fastest change in human history. The lives that we live are more different to the lives of our parents and grandparents than has been true for any previous time in human history. And that's illustrated by the most valuable companies in the world. In 2007, of the top 5 most valuable companies in the world, 3 people who sold you petrol and 1 company that sold you light bulbs for your car, out of 5. And now, in 2017 and beyond, top 7 companies in the world by market cap are all built on top of the platforms on the left-hand chart. And these digital platforms are changing every sector. So if you look at where each industrial sector sits on this curve of technology impact, you've got the stuff which has been fundamentally changed, like entertainment and telco and advertising, which are totally different from how they were a decade ago. And you've got agriculture and healthcare just starting on the journey, and banking somewhere in the middle. We've started to see some important fundamental change, but there's more to go. And that banking change is being fueled by an absolute tsunami of cash, which is being provided by the private equity and the venture funds into these new, exciting fintech businesses. There's been about $100 billion of new money put into fintech businesses around the world in the last decade alone. And if you take out Ant Financial, part of Alibaba, you can see there's a constant upward trend, which is expected to continue. And that money is fueling enormous amounts of innovation. And if we look at financial services in the UK, somewhere in the middle here, definitely one of the leading markets in terms of fintech innovation and bank disruption. Where is Mexico? I guess it's here. It's certainly not at the bottom. There's some exciting innovation going on here in Mexico. You've got a forward-thinking regulator that's creating opportunities for more innovation. You've got companies like Alpha Credit and Credit Justo, who are each raising hundreds of millions of dollars to put into competitive opportunities. And there's more to come. I would suggest that Mexico is in a position to move up the curve pretty quickly. So over the coming years, we'll see something happening like this. And for the organizations in the room that see themselves as the incumbents, you really need to understand that this is something happening now and happening quickly, not something you can take a wait-and-see approach to over the next years. I'm going to illustrate this change with a little case study. There's a company in the UK called TransferWise that does overseas payments. The two founders, the two slightly pale-skinned people there in the middle, they are two young Estonians who were frustrated by the hidden charges that existed in transferring money from where they were working in the UK to their home in Estonia. And so they decided that this is something where technology could help lower the costs and make it more transparent, hence the nothing to hide publicity stunt they did here with their staff all in their swimwear. But let's look at how this disruption happened. So TransferWise was founded in 2011 by two 20-something Estonian kids who decided to try and disrupt this market. In the first full year, they managed to move about $10 million across borders. They did it through a great value proposition, a much lower and more transparent fee for money transfer, but through a fairly clunky website. The banks looked at this and thought, it's not relevant, it's tiny, it doesn't affect our customers, the impact was zero, and the approach was to ignore them. Then if we roll forward 4 years, what's happened now is that TransferWise has developed not just a low-cost proposition, but also a very fast proposition and a great online journey and a great app, making it slick and easy and painless for people to move their money overseas. Now they've moved $12 billion of money overseas. They've taken 10% of that market from the UK banks and money transfer companies, and those companies are now losing revenue. So individuals that do their personal banking with a big bank were taking that particular part of their financial lives outside of their banking relationship, and so the bank was losing revenue. Banks were starting to get a bit worried, but really didn't know what to do with this worry because they couldn't really slash their prices to meet the fintech without cannibalizing their revenue further. So they sat and wait and see. Then if you roll forward to today, TransferWise is now doing $100 billion. They've taken about 3 percentage points of margin out of the banks, taking about $3 billion of bank revenue. And in 2018, they added a new strategy, which was making their service available as a plug-in to other financial services institutions. So they partnered with Monzo Bank, a fintech bank in the UK, so that with Monzo, if you're a Monzo banking customer, you could use TransferWise service white labeled through Monzo at their prices. Immediately, Monzo became 2% cheaper than the next cheapest alternative for moving money out of the UK. And so now people were choosing their bank based upon this service offering. So the big banks were not just losing revenue, they were losing customers to people that were working with Monzo. And it's not just Monzo, they also partner with Xero for SME payments, they partner with BCPE, which is an incumbent French bank with 8,000 branches. So they're doing it with big incumbent institutions as well. And so the banks are now not just losing revenue, they're losing customers. And there's a state of panic amongst the banks about what to do in this area. And interestingly, those dots that we saw are starting to follow the S-curve. So initially, when TransferWise launched, am I going to give my money to a couple of kids from Estonia to send it overseas with a company I never heard of? That sounds crazy. But they're through the crazy stage now. It's no longer crazy. It's now exciting to tell your friends in the pub, hey, I saved $200 when I sent $10,000 overseas to put a deposit down on a car. That's exciting. And soon it's going to be standard and normal. And it's going to be the way everyone expects these things to happen. Another example is that innovators are increasingly outsourcing component processes of their organization. Michael Chertoff talked earlier about the challenges in keeping up with fraudsters for KYC and IDV. And there are a number of companies. One example is Onfido, another London-based company, which has got a team of 250 data scientists working on building the most comprehensive, automated, remote identity verification process, which you can do on your mobile phone in 15 seconds across 500 document types that cover 190 companies. There are a number of organizations in Mexico that are already using this service, and around the world, they're doing 50 million identity verifications a year. Now, most banks don't have the resources to have 250 data scientists building this kind of process, so they need to think about how do you intelligently partner with people who do that better. And then back to Monzo, we talked about earlier. So this is a full-service digital bank now, and it's pulling away large numbers of customers from the Main Street banks. They built their own technology platform, they focused on the mobile, they've decided to make it as slick an interface as possible, and they now have 3 million customers, and they're adding 250,000 new users every single month with very little marketing spend because they've managed to have an NPS, a Net Promoter Score of 80, which is unheard of in the banking industry. They've now got about 40% of their customers interact with them every single day through their banking app. And interestingly, they've got 36,000 individual customer shareholders. So they've done 2 rounds of crowdfunding, which now means that they've got 36,000 customers who are absolutely motivated to evangelize about this product and service and try and recruit their friends because they see themselves as real stakeholders in the business. But what about the tech giants? So we talked about the fintech startups. These tech companies are increasingly invading more and more of our lives. If you want to find something out or know something, where do you go? You go to Google, right? If you want companionship, you probably turn to Facebook. If you want sustenance, then Amazon will deliver anything you want in 24 hours or 48 hours. And just like in the Garden of Eden, the object of your desire or the thing that shows how desirable you are probably comes from Apple. But which of these is going to be the gateway to our wallets and to our banking relationships? Probably the best positioned is Amazon. If we look at Amazon just in the US, there are now over 110 million households that have an Amazon Prime account. Those account holders give Amazon $12 billion of upfront cash in advance from their Amazon fee. And that number, it dwarfs other metrics in the US. The number of people who voted, the number of people who own a gun, other things that Americans seem to think are important. And so with that prime relationship, Amazon has all of your payment details, all of the delivery addresses you've ever sent things to, and enormous amounts of information about your likes and desires and your financial life. And of course, they're already very much in financial services. It's mostly today in payments processing, and lending, the kind of things that help to lubricate their core retail proposition, but they are in a position where they can easily expand beyond that. But Amazon is pretty focused on its core market of the US and a small number of other markets around the world in terms of doing these kind of extension things. So if we look beyond the US, let's look at India and what Google is doing there. So on the back of the government-sponsored UPI payments platform, Google Pay India has shown enormous traction recently. They now have 67 million users. That's 3 times as many as it had a year ago. They're seeing 100 billion plus of transactions per year for consumers who are happier paying with their mobile phone than with traditional payment methods. And what they're doing with merchants is also really interesting. It used to be that to be a merchant, a shopkeeper, to take digital payments, it would be a painful process to sign up for that with a payments processing provider. But now, Google Pay for Business can do a video chat with you, and in 10 minutes can sign you up as a merchant taking digital payments. And they're using that to reach out to the 60 million plus small businesses in the Indian market. But if you really want to see what's happening with the tech giants, don't look at GAFA, look at China. I spent a week in China about 9 months ago looking at the market there, what's going on in fintech, and it was fascinating. Most places I went in China, I could not buy anything. I had cash, I had credit cards, I had Google Pay, and the shops would not accept my money because they would only take Alipay and WeChat Pay. In fact, most Chinese cities now are effectively cashless, and if you don't have these payment mechanisms, you don't have access to commerce. Chinese population is about 1.4 billion. 1.2 billion people have an Alipay account. They do 175 million transactions per day. They have this big shopping event called Singles Day on the 11th of November, where they try to sort of combine all of the power of Black Friday and Cyber Monday and Thanksgiving and Christmas into one day of shopping frenzy, where they see 250,000 transactions per second going through the Alipay system. That's about 10 times as much as the peak capacity of the Visa and MasterCard systems globally. And they've got 100 million SMEs, and they're lending to those SMEs as well, $300 billion of SME loans. This is just an extraordinary scale that we don't see anywhere else in the world. And I think this illustrates where technology giants potentially could take financial services. And moving beyond payments, it's interesting to see what Alibaba has done in another sector. So in 1999, they launched Alibaba.com, which is the China equivalent of Amazon and eBay combined, basically a shopping site. And then shortly after, they found that people were struggling with payments, so they launched Alipay, essentially a simple way to pay with 0 fees, and people had an account which held some stored value. After a while, they realized that people were having surplus cash sitting in those accounts, not working for them. So they introduced Yuabo, which is a sweep account for money market savings. So the money that you had left in your payments account would sweep across and earn an interest rate. And it was really there just to give people an incentive to keep their money there. But they found that people loved the reasonable interest rates, the great user interface that was required, and people started adding money specifically for the saving rates into those accounts. And by 2017, Yuabo was the world's largest money market fund anywhere, with 600 million users and $200 billion of assets under management, essentially just coming out of a payments account. So you can see how these tech platforms with great user experience and good value can dramatically change markets very quickly. So all of that hopefully points to the fact that this industry has an issue. the issue is that things are changing faster than ever before. The kind of changes I've shown you, in 5 or 10 years, markets being dramatically disrupted. That there's now this strong move towards disintermediation, whether it's payments or money market savings or overseas currency transactions. Specialist technology businesses are designing solutions for customers that are stealing away portions of revenue from the banks. And then there's new competition. There's obviously the existing competition from other incumbents that are doing it better and getting to include technology in their offering more quickly than you are. There's competition from the focused, narrower fintechs that are just trying to solve a specific issue. And there's potential competition from the big tech startups that we've talked about. So you could see all of that as a threat, and I'm sure many of you do, but you could also see it as an opportunity. The opportunity is there if you embrace it, and if you can move with the opportunity and innovate. So if you're the kind of organization that can build in to the way it works, to its culture, to its leadership mantra, innovation, then potentially this whole suite of changes that we're seeing is much more of an opportunity than a threat. So in the second half of my talk, I'd like to talk about what are some of the characteristics that I see in companies like Google and some of the best fintechs I work with that illustrate what being an innovative organization looks like. And I'm going to go through the innovation culture rules that I've picked up through 7 different areas. So rule number 1, have a clear, aligned mission as an organization. If what your staff all understand you're trying to do is to make more money for your shareholders, then that is not going to inspire them to do exciting and innovative things for your customers. So you need to have a clear, aligned mission which is about your customer. If you look at Google, when it launched, there were 2 young lads in a garage with a couple of computers, and they came up with this mission statement: to organize the world's information and make it universally accessible and useful. And that's very much about something of value for the customer. It wasn't about being the biggest tech company, making the most money, having the highest share price. It was motivating. And that statement is still used today to try and drive individuals within Google to come up with innovative new ideas. If you look at Amazon, to be the most customer-centric company on earth. Facebook, to make the world more open and connected. They probably slightly overstepped on this a little bit in the last couple of years, but still the ambition is clear. It's about what you're doing for your customer. And I think all of you in your organization should think about whether it's the mission of your company or your department or your team, think about what it is that you're doing for your customer and how do you make that part of something everybody understands. Give people real autonomy. If you give people a very narrow field in which to work, you'll get narrow thinking, you'll get narrow output. If you give them the scope to do innovative things, you'll be surprised by what they can do. And often it starts with having some stories, some narratives within your organization about heroic things that have been done in the past, which were moving beyond the parameters expected. So I'm sure you've all used Street View in Google. The way this started was interesting. So Google Maps had recently been launched. Sergey Brin, one of the founders, thought, wouldn't it be useful if, before I got to the destination that Google Maps is taking me to, I knew what that place looked like? Wouldn't it be useful if I could see on my computer what the shop fronts in that high street looked like? So one weekend, he borrowed a digital video camera, and he got a friend with an open-top car to drive him down Palo Alto High Street in California, and he videoed the fronts of all the shops. And then he went back to his apartment that evening, and he used his programming skills to stitch it together and demonstrate that you could actually have an overlay on maps that showed the shop fronts. He took that into the office on Monday and said, look at this, isn't it cool? We should do this for all the streets in all the world. And that's what's since happened. That wasn't in his job description, that wasn't in the shareholders' letter, it was just somebody having a very brilliant idea of something new you could do. And many of the tech organizations now have this concept of 20% time or Friday afternoon freedom or something which allows people to do things that are outside of the core mandate of their day job, to come up with new things that are still consistent with their company's mission, but are something extra. And what you see here is some images from Google Earth. There was a time in the mid-2000s where there was a team working in India, and they were working on improving Google Maps. And what they spent all their days doing was making maps of London and New York and Paris better than they already were. But they were already pretty good. And these people living in India couldn't even buy a decent map of the city in which they lived. It didn't exist. So they had the insight in their 20% time that if you could use the photographs we already have from Google Earth, and if I can use the knowledge of the people who live in those places and give them a tool to allow them to annotate those photographs, a bit of technology can easily look at it and say, 3 people have uploaded this line and called that High Street, so that's probably High Street. And that's where Google Map Maker came from. And this video here shows Rawalpindi, which is an area just outside the Pakistan capital. This is 6 weeks of user-generated submissions of people labeling stuff on the map. And you can see Rawalpindi went from being unmapped to being perfectly mapped through a crowdsourced process. And in the few years after Google Map Maker was launched, the percentage of the Earth's surface that was accurately mapped went from 20% to 95%. And it was all done for free because somebody was given freedom to work outside of their day job. So just think about the creativity that exists in your organization and how you could unleash that if you gave people a bit more freedom. Giving them that freedom, though, also requires you to allow them to fail. If people are afraid of failure, they won't try anything new. The fastest way to succeed is to double your failure rate. If I was to ask you, hands up if you'd like to fail twice as often. Go on, hands up. A few brave hands, but probably not that many. But actually, given that the fastest way to learn is to learn through failure, the objective really should be to fail very cheap, very quick, very often in a way that doesn't impact your customer so that you can learn from it and move forward. And to illustrate that, I love this little story of the early days of Android. I don't know if any of you have Android phones now, but certainly 10 years ago, most people in business wouldn't have. They would have BlackBerries or iPhones, and Android was seen as a phone to buy for your teenage kids. Okay? The Android team really wanted to demonstrate that Android phones were robust and reliable. And a 23-year-old marketing junior decided that the best way to demonstrate that was to send a phone to space and show that it could come back safely. Now, that was probably going to fail. If he thought that on failing he would get in trouble, he would never have tried. But the culture there allowed him to try. It was only going to cost a few $100s, and it wasn't going to do any harm. So we're going to play this video now. This is Tom, the Android mascot. Tom was put onto a polystyrene platform and attached to one of these high-altitude helium weather balloon sensors and sent up. He had to get permission from the aviation authority. He had to pay a $20 license for it. And he put his Android phone here, looking at Tom here, recording the journey. There's a lot of bass here, isn't it? It's like a disco. So as Tom went up, the helium in the balloon took him higher and higher, and the balloon obviously expanded as it went up until the balloon burst because it got so big. And then Tom started coming down. All the while, the Android phone is recording the temperature of minus 50 degrees C, the altitude of 20,000 meters, the speed and the G-force, and it's recording the video of Tom's journey. And Tom there is having the ride of his life, enjoying it until he gets hit by the rope. And we never see Tom again, sadly. Tom is lost. It's funny how people always have sympathy for Tom. He's a plastic toy. But anyway, Tom didn't come back. But the phone has a GPS unit in it. So the phone was found. The phone was taken back to the office. All of the data was uploaded. It was put onto a blog. A video was shown on YouTube, which demonstrated that this phone went to space, came back safely, and that's the Android operating system's robustness. Now, hundreds of thousands of people saw that YouTube video, which was great ammunition in a sales call to a corporation that says this Android phone is reliable. But more importantly, and quite fortunately, one of the people that watched that YouTube video was working at the time for NASA, the American Space Agency. And they saw this, and it made them think, okay, so we've got some sensors going up in the next mission, which are normally going to spend tens of thousands of dollars on them, and actually we can just put an Android processor in there instead, which they did. And there was a second cycle then of news coverage saying Android-powered sensors in space with NASA. And so the next time there was a sales call, and an enterprise saying, not sure we can use Android phones for our enterprise sales force, not sure it's reliable enough, you say, well, it's been to space and it's used by NASA. And that was only possible because somebody was given the freedom to do something that might fail without fear of punishment. And the other thing about learning from failure is often you have to launch stuff before you're really comfortable that it's ready. If the Wright brothers hadn't launched their plane before they knew it wouldn't crash, there would be no planes today. It was clear that the Kitty Hawk was going to crash, but the only way they'd learned about how it would fly before it crashed is to start flying the damn thing. And so sometimes with your products, you need to get them into market to get real customer feedback, even when you think they're not perfect. And too many organizations live in a world where the perfect is the enemy of the good enough. And good enough is the best way to get stuff out there and get velocity in your business. This is a lovely quote in that area by the founder of LinkedIn. If you're not embarrassed by the first version of your product, then you've launched it too late. Now, I'm not talking about being embarrassed because you've had a data security breach or because you've broken some regulatory rule. But sometimes you're embarrassed because you think, oh, that menu structure for my new website is a bit clumsy. I wish I'd done it differently. I wish I'd tested it more. But the way to test it is to put it in the hands of your customers and look at the data. And so that requires getting stuff out there quickly and early. Next, use data and kill the hippo. Hands up if there are any hippos in the room. I'll ask you again in a minute. So using data. In technology organizations, in organizations that have the right mindset, they will always seek data to make an input to a decision. This is best illustrated by this example of choosing the color blue in the Google search results. So you might remember early Google, you had the natural results down the left. On the right-hand side, you had the clicks away to the advertisers. That was a certain shade of blue. Then when they launched Gmail, they put an add click link, which was a slightly different blue. It was a mistake. The designer picked the wrong blue. In a normal organization, the way you would resolve that, you would ask the product manager or the chief marketing officer just to choose the right blue. In a data organization, you ask, is there an experiment we could do, an experiment that will determine the right blue? And that's what Google did. They ran a series of 42 different 1% experiments where you make your site visible to 1% of your audience with a different variant, 42 different blue variants. And then they learned that people preferred and clicked more upon a blue that was slightly more at the purple end and less at the green end of the spectrum. And you might think, well, gee whiz, that's a lot of work for a tiny change, who cares? But actually, consumers cared enough that the additional click-throughs they got from the better blue added $200 million of annual revenue to Google's income stream. So that's a little test that has a big impact. And you need to have a cultural mindset in your organization that says, go find me data that is going to inform my decision and make it a better one. So why the hippo? We all know that the hippo is the most dangerous animal in the safari park. It's also the most dangerous animal in the boardroom, because in the absence of data, you tend to rely on the highest person's opinion. The highest paid person's opinion, excuse me. The highest paid person's opinion is the hippo. It is the dangerous beast in the boardroom, because typically the highest paid person is the furthest away from the customer or from the product or from the website, and they are very good at having views on issues of strategy and issues of long-term vision. But choosing the blue, you don't want the highest paid person having that opinion. You want data. So hands up if there's any hippos in the room. Okay. Right. Data is all very good, but there's so much data out there, we can often drown in it. So you need to make data visual. In fact, if you've got a team of 5 data people in your company, at least one of them should be a data visualization person to help management make sense of the numbers that are coming out. To illustrate this, I'd like to show you some data that comes from a clever data scientist that downloaded about 4.3 million four-digit passwords from the dark web that had been hacked in various different breaches. So these are PIN codes from ATM cards, from answering machines, from mobile phones, and so on. What you can see here is that people are pretty lazy. A lot of people have the default 1234 or 1111, and people are just pretty stupid about PIN codes. But beyond that, you don't see much from this data. But if I visualize the data like this, you learn a hell of a lot more. So this visualization shows on the bottom axis the first two digits, and on the side axis the second two. So if I was 2080, it would be 20% of the way along the bottom and 8/10 of the way up. And the color, the brighter it is, the more people chose that number. So from this we can learn a whole lot more. What does the diagonal line tell us? This line. Yeah, exactly. People are too lazy to choose four digits. They just pick two digits and double and repeat them. So you've got 2525, 36, 36, or so on that line. From here, the vertical line here, what can that tell us? Any idea what that line is? The year you were born. Exactly, somebody said over here. So that's 19 something. So you can see the year you were born. The year you were born, you can find that out, plus or minus a year, from your LinkedIn profile. That's not secure at all. You can also see from this chart that there's a kind of a brighter band in the higher numbers. There are much fewer at the bottom because those people are mostly dead. Or they're too old to have electronic devices. And right at the top, there's a darker patch because people are too young. So you can learn some interesting things from this. And this block here is dates of birth. By looking at the bumps at the top, you can actually see how many days in the month there are. In January, February, it drops down to 28. Who'd have thought that from hacking PIN codes, you could work out that there are 28 days in February? And then lastly, you can see the hotspots here, 1234, 4321, and then straight down the middle of the PIN code, 2580. So this tells you a lot in a visual design. Hopefully, it will tell most of you to go and change the PIN code on your answer machine when you get home, or whatever, but also illustrates the power of data visualization. Next, be terrifyingly open. Most organizations are afraid of sharing too much, but your teams can only really innovate if they know the broader context in which they're working. So at Google, they have a stand-up once a week, every Friday, where the whole company is told everything that's going on. All of the strategies, all the marketing plans, and so on. And occasionally you get leaks, but the company believes that the value of the additional creative space that people have by knowing the strategy outweighs that. And actually on the intranet, on the personal profiles of every Google employee, you've got this link to their objectives and key results, which is visible to the whole organization. Next one, and this is perhaps the hardest one for many organizations, is cannibalize yourself. So we all know that cannibalization is where revenue is stolen by a new and different and better product. That can be done by somebody else, or it can be done by you. And clearly it's better that it's done by you. We all know the story of Blockbuster. Is Blockbuster in Mexico? Used to be. Yes, used to be. Like everywhere else, it used to be. So Blockbuster IPO'd in 1999. A year later, they had the opportunity to buy Netflix for 1% of their IPO revenues. And they chose not to. Do you know why? What was the revenue model of Blockbuster in its day? What did it make its money from? Late fees. It made its money not from the rental that you wanted, but from the fact that you didn't bring it back until 3 days later. And the Netflix model doesn't have late fees. It was therefore fundamentally lower margin. The Blockbuster executives didn't like it, so they didn't go there. And then there are similar stories for the other pictures. And in fact, the Netflix story's got an interesting second chapter. So Netflix started with DVDs mailed to you in the post. But they always knew the future was going to be in streaming, in downloading stuff electronically to your device. when Netflix got to 10% of revenues coming from streaming, they took the two executives that were in charge of the DVD rental business off the main executive committee. And they said, right, you're responsible for 80% or 90% of our revenues, but your mindset is getting in the way of our future. So you go and have your own meeting over there, and we'll have a digitally focused executive thinking about the future. Can any of you imagine in your bank, if you had a branch-based bank and a digital bank, saying that the branch-based leadership should not come to the executive meetings? That was a decision that Netflix took. And then Google had a similar issue when mobile came. Mobile was lower revenue because the advertising ecosystem was less developed. They had the choice of either slowing down the adoption of mobile by making Google's products worse on mobile, or by making them even better and saying, okay, we're going to lose revenue in the short term, but we're going to own mobile in the long term. And that's what they did. And now Google has a higher share in mobile search than it ever had in desktop search. And lastly, think about innovating 10x, making your innovation ambition to be 10 times better than you are today, rather than just incrementally better. So the big tech companies, certainly Google, has a way of ensuring they've got enough focus on the here and now, on the coming soon, and on the long term. In Google, all of the engineering and product resource is calibrated such that 70% is on the core business, 20% is on adjacent stuff, which is nearby but less proven, and 10% on crazy stuff they have no idea how it's going to monetize, but it's helping to organize the world's information and make it universally useful and accessible. And you might think about something similar in your organization. And actually, to try and make sure there was enough focus on that 10% on the right-hand side, they launched this thing called the Google X Labs, where they do these moonshot projects, which are trying to tackle a huge problem, something that is faced by tens of millions of people around the world, where there's potentially a radical solution, something that sounds a bit crazy, but is only possible because of recent breakthroughs in technology. If you think about driverless cars 10 years ago, it's hard to imagine it now, but 10 years ago, the big problem was that 1 million people around the world are killed in car accidents on the roads every year, but they're not killed by other cars, they're killed by the drivers of other cars, typically making bad choices, being tired, being drunk, being distracted. So the radical solution is, if the drivers are causing the accidents, then take the driver out of the control position in the car. And the breakthrough in technology was that we now had high-quality maps, good, accurate GPS, etc., to make this possible. And now you can see, you've seen videos like this, I'm sure, many times, and the self-driving car is actually the safest car on the road. Any diabetics or friends and family who've got diabetes in the room? I'm sure many of you. Issue here is that there's quite an invasive process of having to measure your blood on a regular basis. Turns out that the fluid in your eye has a high correlation with your blood in terms of its sugar content. So the crazy idea here is, hey, why don't we stick a glucose meter in your eye? Now that sounds mad, it sounds science fiction, but with miniaturization technology, there's now a Google and Novartis joint venture project to put a glucose meter on the rim of a contact lens to help people measure and communicate with their mobile phones their glucose levels. And lastly, just to test your powers of 10x thinking, think about how do you break your mental paradigm. So the mental paradigm of wind turbines is that they are more efficient and they generate more electricity if they are higher up, because the wind is stronger up there. So the way this has been achieved historically is to build taller towers, or put them on hills, obviously, but taller towers. And that means more concrete and more steel and more cost. So how would you go about putting a wind turbine higher up with a 10x mindset, rather than incrementally adding a few meters each time? Any ideas? This is the interactive bit. Any ideas? A plane, here we go. So the perfect hook there is a plane. So planes manage to go high because of the Bernoulli effect on the wings. And what Google is doing in a joint venture, which has now been taken on by Shell, is to say, actually, why don't we put the turbines on a glider wing, and then you pump electricity through the cable to spin the turbines that lifts the wing, and then when it's up there, you turn the power off, the wind blows through the glider, keeps it up there, and turns the propellers the other way, and sends the power back down the line. And now you can move your turbines not up another 10 feet, but up another 400 feet or meters, and get a more efficient system. And so I know you guys are not in the industries I'm talking about, but you will all have business processes that could do with a 10x treatment. Imagine you've got a business process like account opening that currently takes you 10 days. If you ask your team to make it 9 days, they will do everything the same but try and do it a little bit better. And you won't make any breakthrough. If you say to your teams, I want that account opening process to be same day, they will have no choice but to re-engineer the whole thing with the latest technology, to think about what I can do with online signatures and artificial intelligence and outsource IDV and so on. And they might come up with the answer. They might not, in which case you will forgive them, because we've learned about forgiving failure earlier. But the chances are that that different approach to the challenge will come up with new and fresh thinking, and you'll have the chance to move forward, not just keeping up with the incremental improvements of the competition, but leapfrogging them and doing something new. And then to close, back to the automobile. So this is the Easter parade in New York City in 1900. What we can see here is lots and lots of horses and one car. This was the crazy guy with the automobile in 1900. Many of you might be thinking that, yes, sure, banking is going to change, but it's going to change in decades, not years, so I don't need to take action today. That was what all of these horse people thought at the time. 13 years later, the same event, the same place, thousands of cars and one horse. Don't be the horse, ladies and gentlemen. Thank you very much.
Thank you so much, Mr. Cobley. We're moving on now to our question and answer section. Solicitamos la presencia del licenciado Luis Niño de Rivera, presidente de la Asociación de Bancos de México, como moderador de esta sección.
Dan, a great pleasure. Thank you so much. We're awe-stricken by two things, speed and magnitude. Now, there's also one added feature, direction. Where is this going as far as fintechs and big techs? What is leading them? Adding to their business a different service, which is getting into the financial services, or using financial services to enhance their business?
So thinking about the likes of Google and Apple, certainly my belief is that their primary motivation is to use financial services to enhance their ability to win in their core business. So if I think about Amazon, Amazon is lending to small business merchants, not so that they can make a significant margin on the lending interest rate, but so they can give more liquidity to the merchant, so the merchant can buy more Amazon advertising and can move more stock and to put more economics through the system. And then likewise with Google, the majority of what they do outside of their core advertising business is done to, in some way, enhance that advertising business. So the primary motivation for Google in payments is to close the information loop that says, I showed my customer an advertisement for this product, and then I saw through their payment device that they bought that product, so I can go back and charge the advertiser more for the advert next time. And so I think that's the primary motivation.
We complain permanently in the banking industry about regulation. But then when you think about fintechs and big techs and the taking over of certain services, we believe that regulation is going to be a way to defend ourselves from that, because these companies tend to shy away from such strict conditions in the banking industry. How true is that?
I think I would look at the fintechs and the big techs differently. So starting with the narrow fintechs, most markets now have some kind of regulatory environment to encourage the development of new fintech models. It may be a fintech sandbox, or it may be narrow regulatory regimes like an e-money license or a lending-only license or whatever. And I think it's right and appropriate that the regulators should give those fintechs the opportunity to get into market without the burden of a full banking license, because that will kill innovation. But it's also important that as those businesses, those fintech businesses get bigger, that the regulatory oversight grows with them. Because if you've only got 1,000 customers and something goes wrong, you don't do much damage. When you've got 1 million customers, something goes wrong, you do a lot of damage. And so the regulators have to be alive to that. In the big tech world, big tech companies hate regulation and they hate national differences. So the motivation for the business models of Amazon and Google and Facebook is, let's create something that I just need to translate and otherwise works the same everywhere in the world. And the great or the awful thing about banking is that every country is incredibly different. From a consumer behavior point of view, from an incumbent offering point of view, and particularly from a regulatory point of view. And so the US market might be big enough for Amazon or Google to go through the pain of building up their regulatory capabilities and so on, but I can't see them doing that across all of the countries of Central and South America, for example. I think they're much more likely in those situations to partner with banks that have already learned how to do that, and to use that partnership as a platform to go forward and build on.
You're deeply involved in the fintech world, not only in the UK, but outside the UK, particularly in the United States. What is the trend? Where is this going? Is it money transfers, the movement of money, payment systems? Is it credit? Is it savings? Where is it going?
I think it's all of those things. I think if you go to Money 2020, the big global fintech conference, you will see every single area of banking represented by new fintech startups. Or if you subscribe to CB Insights, a very valuable online resource for what's happening in the innovation space, you'll see market maps with every dimension covered. I think what is interesting now, though, is that the fintechs initially were very narrow slices of financial services, so payments or money transfers or SME lending. And increasingly now we are seeing some of the bigger ones have the ambition to aggregate some of these services together and create more of a full service. So you look at the neobanks like Monzo I talked about, adding in TransferWise, putting in Onfido and so on, and creating something which is a more holistic offering. And then I think there's a challenge for the incumbents as to how do they compete with that, and is it a partnership model or is it a head-to-head competition that's going to win?
In a world of disruption as we are living today, the eternal question for incumbents, for big businesses, for big banks, is whether to try to grow organically, develop in-house fintech capabilities, or to buy somebody else. In your experience, where is this having the biggest success? Are banks more inclined to bring somebody from the outside because it's very difficult to build a space in a business that's going well, and everybody shies away internally for someone to be disruptive in making them look not as good? Or can you really do it in-house and be disciplined and have somebody make the mistakes and not be thrown out the door, and creating new opportunities?
I think it can only work in-house if it comes from the very top all the way down. If your CEO and your board are mandating that you change your organization, and the objectives and the bonus metrics and so on are all aligned to that, then I think it can work in-house. But if it's a satellite operation that is being driven by a missionary vice president that doesn't have the support of the organization, they will have some local successes, but then when they try to take those pilot projects back into the main organization, the organization will kill it. And so it will be a waste of time, unless it's coming from the very top. So I think you either have the option of taking it from the top and doing some stuff internally, or if you don't have that positioning, then your best bet is just to use the fintechs as suppliers into your organization and say, we can do our IDV better by using a third party, or we can do our overseas currency by using a third party. And then it's more of a vendor-purchaser relationship.
And the final question, Dan, time.
Yep.
Most people that are, as you clearly point out, that are being successful in their business feel comfortable enough, the horse in the car. But how much time do we really have? If we start today and try to build new technology capabilities in the banking industry, in the financial services industry, is this a question of 1 year, 2 years, or do we still have 5 to 10 years in front of us?
I think inevitably it's going to take 5 to 10 years to re-engineer big banks, but you need to start now if you're going to have any chance of getting there in that time frame. We all know how big these projects are, how long it takes to fully integrate new technology systems or new partners. So if you don't start now, then you're going to look back and say, I wish I had done.
Very good. Thank you so much, Dan. This has been a wonderful presentation.
Thank you very much.
Thank you.
Thank you so much, Mr. Cobley, and ABM's President, Mr. Niño de Riviera. Concluimos nuestra sesión de preguntas y respuestas con la participación de